So as I was explaining, I said we're going to have an estimate within 2 years, within 2 months, in which a company commences the accounting year or the tax year. So what we're trying to say here is that that estimate shall be based on your budgeted transaction, what you have budgets to spend in that particular year. That is what your estimate is going to be based on. So, and that estimate must be filed and submitted to the tax authority within 2 months of the current year. So basically, I am saying that we have 2 types of return that must be filed by a company in the operation of petroleum space, which is number 1, the annual returns, number 2, the estimated returns. Now, upon these estimated returns, the taxpayer is expected to pay its tax liability on an installment basis. The taxpayer is what? Expected to pay his tax liability on an installment basis. So, and the first installment shall be due within 1 month after you have filed your estimated returns. So this is what I am saying. I have said within the first 2 months, the company must file its estimated returns, right? That is January and February. Within January and February of the current year, you must file an estimated returns. And these estimated returns must be submitted to the FIRS not later than 28th, depending if it is leap year, 29th of the current year. Upon that estimate, you must be making payments on it on a monthly basis. So if you have estimated that you're going to make certain amount of money, and at the end of the day, you have computed your tax within yourself, you will divide that estimated tax by 12, and on a monthly basis, you're going to be remitting to the tax authority. You'll be remitting to the tax authority on a monthly basis. Now, there could be a possibility that you now have a grasp knowledge of the environment, of the market condition. Possibly, maybe the oil price has gone up. The taxpayer would send a revised estimate to the tax authority. That revised estimate, it is what the tax authority will now use to be assessing you again going forward. So that revised estimate, you now need to revise your estimated return. So the price could have gone up or come down. If the price comes down, you revise it downward. If the price goes up, you revise it upward. Now, what we're trying to also say here is that whatsoever that you have paid before the price revision must be deducted from what you are going to pay going forward. Okay, so imagine a situation whereby your tax liability or your tax estimates had reduced. So let's say you're supposed to be paying estimate on 100 million before, and because of the lower price of the crude oil in the market, the price of your estimated returns, your estimated tax return now is now reduced to, like, let's say 70 million. And let's also assume that you had already paid for 5 months. So what you will do in that instance is that you're going to say total estimate 100 million. I have paid 5 months. 5 months, let's say 5 months, that is 100 million divided by 12 the other time. You would have had something with the range of maybe 5.6 million. So you have paid, let's say you have paid 5 million. So you have paid for 5 months. So that is 25 million. You will say 100 million minus 25 million. That is what you have paid. Divided by 12 minus the month that you have paid for. You have paid for 5 million, 5 months, divided by 12 minus 5. So the number of months left to be paid now is what? Is 7 months. Sorry, 70 million. Now that is the revised estimate, not the 100 million. 70 million minus 25 million that you have paid, divided by 12 million, 12 months minus 5 months. That would show you the new estimate that you're going to be paying. Let me recap. Initially, you're supposed to be paying estimates on 100 million. But I've said, let's say 120 million, so that it can be easy. So 120 million. So if you divide 120 million by 12, you have 10 million. let us assume that you have paid 4 months. That is 40 million. Now, let's assume that the revised estimate now is now 60 million, and you have paid for 4 months. So you now say 60 million minus 40 million divided by 12 minus 4. 60 minus 40, that is 20 million. 12 minus 4, that is 8. That is 20 million divided by 8. Whatsoever you get, that is what you are going to continue to pay as estimate. Now, it is instructive to note that at the end of your total instrumental payments, there could be a possibility that there's always a possibility that when the audited financial statement comes, the annual returns, which is the annual returns will most likely, most of the time, more than the estimated returns. So the difference between your annual returns and your estimated returns is what we call 13th month. Are you listening? The difference between the annual returns and the estimated returns is what we call the 13th month. Now, this 13th month is what the taxpayer will pay as additional tax liability to the tax authority. Now, because it is not also very easy for companies to prepare their audited financial statement, that is why the Tax Act gives the company 5 months after the accounting year, for them to be able to submit their annual returns. Okay, so the annual returns is for the activity of prior year. The 13th month, your estimated return of your prior year, plus your annual return of your prior year, you compare the two and you pay the balance to the government. So you are going to see the situation as we go ahead. Now, what are the content of returns? You know the content of returns. Number one is the audited financial returns or financial statements. Audited financial statements is the first one. Computation of adjusted profits. Schedule showing capital allowance of the company. Also, schedule showing the asset of the company, the one that you dispose within the year, the value of the assets, and so on. You must present that schedule. Now, computation of actual chargeable profits. If you are on the 2 classes of assets, you have to know what you charge. Okay, can you all mute your phone? If you are not talking, mute your phone, please. So the next one is you also show a computation of your chargeable tax for the period. You also show a computation of your production allowance for the period. Okay, and you complete the self-assessment form to be attested to by the principal officer of your company. To be attested to by the principal officer of your company. And also, I can read one for you here. I, so person, hereby declare that I am the CFO of this company, and further declare that the particulars contained in this summary and attachment therein are true and complete. Are true and complete. You get? So it must be attested to by that company, by the principal officer of the company. And you must also now send alongside the evidence of the final installment. That is the 13th installment. That is the 13th installment. If you are there, I am there. So that's that. Now, also, as you have for estimates. So as you have for annual returns, you also have for estimated returns. What are the content of estimated returns? The same thing, except for the fact that in this one, there won't be self-assessments, there won't be attestation to anything. You just send them your what you have. You compute your adjusted profit on estimates, estimated estimates. You compute your capital allowance on estimates. You know all those things. They will be on estimates. Do you understand me? So that is that. Now, having said that, let's go to an illustration. There are penalties for failure to file returns. What are the penalties? 10 million for the first day in which the failure occurs, and 2 million for every other day in which the failure continues. So that is the penalty for failure to file returns. So let's look at our illustration number 5. Illustration number 5. Mirror Petroleum Development Company Limited submitted its estimated return to FIRS on this date with tax payable, that is the amount that this company will pay, 60 million. In July 2023, it submitted the second estimate with tax payable of 84 million. Just like I've told you, this guy had increased his estimated returns. The initial returns that this guy filed was 60 million. But now this guy is filing 84 million. That means it has increased. Now it's in November 2023. It's also submitted a third estimated returns with tax payable of 90 million. You are required to indicate the due date of payments of monthly installments and compute the monthly installment payable. If the final returns show a tax payable of 113 million, determine the taxing installment. That is actual return that has now been found. So let's go. The first month of, or the first due date of estimates shall be March. You remember that I told you that when you file your returns within how many days? Within 2 months. Okay? Within 2 months, you file your returns. Within 2 months. So when you file your returns within 2 months, okay. Check. If you file your return within 2 months, 1 month after, you must pay your estimated tax. So the due date for the return that you have filed is 1 month after February. So that means the first due date will be March. Now, don't forget that this company, just like I've told you, the first estimate was 160 million. That 60 million, you will divide it by what? By 12. So you first get 5 million. Now, remember that this guy revised his estimates in July. That means from March to June, this guy was paying 60 million. Was paying estimate of 60 million. That is 60 million divided by 12. So it will pay 5 million. 5 million, 5 million, 5 million, 5 million. But in July, the estimate changed to 84 million. And don't forget, the total estimate now is now 84 million. So you will say 84 million. How much has this guy paid? Using the old estimate, he has paid 20 million. $20 million. So you say $84 million minus $20 million divided by, he has paid it for 4 months before that change. He has paid it for 4 million. 4 months before the change of the estimate. So he has paid for 4 months. That is 12 minus 4. You will now have 8 months left So, and the new estimate now is 84 million. So he has paid 20 million before the new estimate comes. So you will say 84 million minus 20 million, that is for 4 months, divided by 8. You have 8 million. So in November again, this guy changed his estimates. Change his estimates to 90 million. So he has paid 20 million. He has paid additional for 4 months, which is 32 million. So 20 plus 32 will be 54, minus 90 million will be 38. Now, the total number of months now is 8 months. So I'm going to say 12 minus 8. You would have 4. So divided by 4, whatever you have is. Now, that is the entire. Now, when you look at this, you notice that the first one started from March, April, so the next year. That is, the estimate will be paid till the next year. And the 13 installments will be paid after the filing of returns, annual returns. And this is the final installments, the final tax liability that the company is supposed to pay. But the company had paid 90 million before. So you just say the final installments, 113 million, minus the estimated return, 90, the balance will be paid as your final installment. So let's go again to our computation for today. Now, I'm very sure that you understand that, but you can also still consult your study pack as there is not much time for us to use. Now, for the purpose of hydrocarbon tax computation or for petroleum companies are now to pay tax liability on the hydrocarbon tax and companies' income tax. On the hydrocarbon and companies' income tax. And in that case, there are some things that we need to talk about. There are some things that we need to talk about. What are the types of revenue that this company that is into hydrocarbon would have? What are the types of revenue? Now, in doing that, I want to quickly open the type of revenue. Sorry, I don't look for the. Yes, in our last class, we talked about the types of revenue. We talked about adjusted profit and allowable profit and non-allowable expenses. We've talked about that. But let's go. Before we go, I think it is important we talk about capital allowance and production allowance. It's important we talk about capital. We talked about capital allowance last class, right? Yes, we must have talked about that. We talked about capital allowance before we go to this stage. So we've talked about capital allowance. We've talked about cost profit ratio in our last class. Now, what is the purpose of cost profit ratio? I remember I told you that the purpose of cost profit ratio is for the tax payer to be restricted to 65% of the total revenue of the company. Now, to be restricted to not more than 65% of the total revenue of the company. So by so saying, the expenses of the company shall not be more than 65% of the total revenue of the company. Now, if it is now more than that, it has to be restricted. That is the purpose for cost profit ratio. We're going to be seeing it as we move ahead. Now, let's look at this format quickly. In this format, I have been able to put some clarification there. There are some income that are taxable under hydrocarbon tax that are not taxable under company's income tax. They are taxable under hydrocarbon tax, but not taxable under company income tax. Sorry, they are taxable under company income tax, but not under hydrocarbon tax. So, what we're trying to say here is that not all income will be subject to tax under hydrocarbon tax. Not all income of the taxpayer will be subject to tax under hydrocarbon tax. Meanwhile, all the income of the taxpayer shall be subject to tax under the company's income tax. Okay, now if that is the case, so these are the income that will be subject to tax under hydrocarbon tax. Crude oil sales, both export and local, condensates, and NGL from associated gas. These are the three that are subject to tax under hydrocarbon tax. Condensate could come in form of propane, butane, methane. So I think I've seen a question before where examiner put the classes of condensates. So condensate could come in various forms. It could come in form of butane, it could come in form of pentane and propane. Okay, depending, but examiner, I don't think examiner would want to bore you guys with the technical aspect of types of condensate. Okay, but it could come in such a way. Now, all other things that I've put here are not going to be subject to tax under hydrocarbon, rather under company's income tax. Example of such is associated gas and non-associated gas. Now, there is difference between NGL gotten from associated gas, and there's difference between an associated gas. Now, when you talk about this associated gas I put here, it is the associated gas that the company produced by themselves. Associated gas that the company deliberately produced. Now, what is associated gas? Let me explain what associated gas means. And you remember when you were doing your process costing. In your process costing, they must have told you that there's what we call normal loss. There's normal loss. Now, for normal loss, what does that mean? When you talk about normal loss, it means those are the losses that will accompany the finished products irrespective. Imagine I want to produce a desk, table. You know, I have to file the wood to make it smooth. Now, if we now have a use for that shaft that's taken away from the wood, okay, that is what we call normal loss. And that is the same thing as associated gas. Associated gas are the gas that you produce alongside with the crude oil production. The intention of the company is to produce crude oil, but associated gas comes along with it. What was the intention? The intention was to produce what? Crude oil, but associated gas comes along with the crude oil. So that means that kind of associated gas will be allowable, will be taxable rather under hydrocarbon tax. Meanwhile, there are some companies that produces associated gas by themselves. Associated gas is produced for its own use. The company produces associated gas. It's not as if the gas was as a result of the fact that they produce crude oil. No, that is not it. It was produced because the company have a need for the production of their generation. So that kind of gas will be subject to tax under company income tax, not under hydrocarbon tax. Subject tax under company income tax, not hydrocarbon tax. We move on. Liquid petroleum gases. That's the gas we use at home. It is under company income tax. Natural gas transferred from upstream to midstream. That will be under CETA. Now, PPT recognizes incidental income. PPT recognizes incidental income. But as we speak, PPT does not recognize incidental income any longer. Rather, you will have to put incidental income in, what is it called? Incidental income will be, I'm coming. Incidental income will now only be subject to tax under the under the company income tax. But before now, under company's income tax, under petroleum profit tax, hydrocarbon tax, incidental income is subject to tax under petroleum profit tax. But now, incidental income is not part of the definition of the income that can be taxed under hydrocarbon tax. Both based on price and production. We have administrative expenses. Royalty will be taxed on will be liable for both hydrocarbon and CIT. Production expenses are liable by both CIT and hydrocarbon, and so on and so forth. Now, when you come to this side, contribution to approved pension fund is not liable under company. It is only liable under company income tax, but not under hydrocarbon tax. Gas flare is not liable because you remember we have said under the liable expenses that we treated before. I said the government wants to encourage companies to invest in gas infrastructure, and therefore any cost that the company incur in gas reinjection, it is liable expenses. The next one is custom duty. It is not liable. Purchase of information related to existence and extent of petroleum deposit is not liable. Production bonus not liable. Interest of borrowing, it is not liable under company income tax. Under hydrocarbon tax. Meanwhile, it is liable under company income tax. Bank charges, not liable under hydrocarbon tax, but it is liable under company income tax. Litigation expenses and bad debts, not liable under hydrocarbon, but it is liable under company income tax. Donation, not under hydrocarbon, but liable under company's income tax. So those are it. Now, one thing that is also very important for us to know is that our expenses in a particular year shall not be more than 65% of our revenue. And that is what the cost profit ratio does. Let's go to the templates for cost profit ratio. Now, how do you compute your cost profit ratio? How do you compute your cost profit ratio? You would have your gross revenue. You would have your gross revenue, which is going to be what you have calculated in your question. Maximum allowable is 65% of your gross revenue. Now, you now need to calculate OPEX for CPR limits. That is operating expenses for CPR limits. Now, the first thing you will do, this is only applicable to hydrocarbon tax, not company income tax. Okay? So the first thing you will do is for you to say, what is my total expenses that I've generated in the year? You bring it in. The act says you should add capital allowance to it. You add capital allowance. You will now deduct the following: contribution to pension scheme arrangements. To pension scheme or arrangements, you will deduct that. You will deduct contribution to host community will be deducted. Contribution to host community will be deducted. Any contribution to Niger Delta Development Fund will be deducted. Royalty will be deducted. Rent or PPL will be deducted. Rent or PPL will be deducted. So whatsoever you have, you will now compare this value with this value. This value with this value. Whichever is lower is what we are taking. Whichever is lower is what we are taking. So by implication, your expenses shall not be more than 65% of your, what's it called? Of your 65% of your revenue. Amaka, go ahead. Amaka, you have a question. Go ahead.
Okay, yes, sir. So my question is, you said that donation is not allowed under hydrocarbon tax. So why did we deduct this contribution to host community? Is it not in form of donation?
Thank you, my dear. There is an act that talks of host community development fund. And I thought I've taught you that for host community, all oil companies are mandated to set up a host community development fund, which is going to be 3% of their prior year operating expenses. Do you understand? Which is going to be what? 3% of their prior year operating expenses. And that shall be treated as allowable expenses. So it is not donation. There is an act that has set up that for the purpose of this.
All right, thank you, sir.
Good. So let's go ahead. So that is that. So we're not saying that at every point in time, your expenses shall not more than 65% of your revenue. If it is more, you will restrict it to 65% of your revenue and you carry forward the balance. Okay? So let's go ahead. So you have right to carry forward the balance until it is fully recovered. So let's look at an illustration. Someone should read it for us. Prosper.
Sir, what illustration?
Illustration
8.
Yes.
Okay. Simino Petroleum Limited is a subsidiary company of a foreign oil and gas company The company has been involved in petroleum prospecting and exploration upstream for both local and foreign sales for over 10 years. As a corporate board policy, the management meets and considers the report in respect of its operation on a yearly basis. The profit for the year ended 31st December 2023 of the company, as prepared by the finance controller, revealed the following. So should I go ahead to name the items?
No, additional information. Let's see through the one after the other.
Sorry?
Additional information.
Okay. You are required to compute the following and give appropriate comments where applicable. A, the adjusted profits and accessible profit of the company. So where is additional information? I'm not seeing this is just the requirements.
Additional information is there now.
Can't see.
You can't see it. See it now.
Okay, the following additional information was provided. The monthly fiscal oil and gas prices of each measurement point have been approved on an export parity basis by the Nigerian Upstream Petroleum Regulatory Commission. 2, unabsorbed losses brought forward from previous year were 35,000. The company operates in an onshore area. The petroleum allowance as agreed with the FIRS is 80 million. The unrecouped capital allowance for the previous years were 51 million, and the current year is 45 million naira. This was also agreed with FIRS. Administrative expenses consist of natural gas flare fees.
Pause, yes. Let's go. Administrative expenses consist of what? Natural gas flare fee. Is that allowable or not allowable? Everybody.
Is that allowable or not allowable?
Not allowable. Next, transportation cost, allowable or not allowable? Allowable. I like that. Cost of obtaining information on existence of oil, on existence of oil, allowable or not allowable?
Not allowable.
Not allowable. Thank you. I have told you. Cost of obtaining information to existence of petroleum deposits is not allowable. Next, expenditure on acquisition of geological information, allowable or not allowable?
Allowable.
I will catch you now. Victor.
Sir, I'm here.
Are you sure?
Yes, I'm here, sir.
Amaka, you want to go and copy your notes? I'm asking you, is it allowable?
Which one? Sorry, I didn't hear you.
I said cost of geological information.
Expedition
is allowable. How? Why?
Yes. So because the two tests for I've forgotten those terms, but the two tests and one other test like that are the first two tests and one other one are actually allowable. I've forgotten the terminology used for that assessment.
Okay, geological, geophysical, and geochemical.
Yes.
So they are all allowable. I told you in the last class. So they now told us other allowable expenses. So in exam condition, what would you do? What would you do? So what you will first take this 79 million, okay? Remove all the non-allowable expenses from it. The balance is what you are going to take into your computation. Do you understand, class?
Yes.
Good. The next one. Sorry, I don't know what's wrong with my hand. Oh yeah. Repairs and maintenance expenses were made up of the following. repairs of pipeline and storage tank, allowable or not allowable?
Yes.
Is it allowable?
Allowable. Allowable.
Do you only have Victor in the class? What about the others? The next one. Improvements to buildings. Allowable or not allowable?
Not allowable. Keep
allowable.
books.
Why?
It's capital in nature, sir.
Good, thank you. The next one. Repairs of plants, allowable or not allowable?
Allowable.
Good. We move on to the next one. No, the next one. Miscellaneous expenses consist of the following: tenement rates levied by government, allowable or not allowable?
Mm.
Allowable or not allowable? That's 2,000.
Allowable, sir.
Allowable. Okay. Allowable. What is that? What are we looking at now? Miscellaneous.
Yes.
Okay. Allowable. Next. Contribution to Niger Delta Development Fund, allowable or not allowable? Allowable or not allowable?
Allowable.
It is allowable. Host community.
Allowable.
Allowable.
Donation to widow and orphanage association.
Not allowable.
Not allowable. The next one. Allowance for bad and doubtful debts.
Not allowable.
Under.
Under hydrocarbon tax.
Allowable under.
CIT.
Good. So in CIT, we have the provisions that we usually use, Abby. Now, out of this, which one are we going to recognize?
Specific and bad debt.
Yes, we are not going to recognize the general provision. So what we're taking there is 14 million, right?
Yes.
Yes.
The next one. Repairs and maintenance. Sorry, head office shared costs.
Not allowable.
Not allowable because we have said it. It is not allowable for hydrocarbon. But when you look at it very well, research and development will be an allowable deduction for company income tax, right? But indirect cost will not be an allowable deduction, okay? So that is that. So we can now go ahead and start looking at what we did in the solution. So in this question, we're given our crude oil revenue, right? We're given the crude oil value. Abi, we're given this, we're given this, we are given this. And value of gas, we are given this. So we go to our, you can see we've taken all those except for this guy that we only took to company income tax.
Mm-hmm.
Abi?
Mm-hmm.
The next one is royalty. I've told you royalties are allowable expenses for both. Abi? The next one is production allowance, allowable. The next one is rent. Rent is allowable. Cost of gas injection, we have said is allowable. If you look at it, we have cost of gas injection in the question. Where is it, sir? Let's look for it. Did you see it? How much is that value? $4,000. Yes. Under the tangible and intangible drilling. $4,000, right? The next one. The next one is cost of first two appraisal well is what is going to be allowed. I have told you there could be several appraisal wells, but it's the first two that will be allowed. So in this question, we are given 3 appraisal wells. So we have to prorate it and take the first 2. The next one is salaries and wages. Tangible dwelling cost is allowed, right? Salaries and wages is allowed. We have treated head office overhead, head office share cost. We have also dealt with repairs and maintenance. Abi, but what is the balance for repairs and maintenance? 7.5. In the question, we had 8.5, 8.90, 8.930. But if you look at the question very well, we have said repairs and maintenance include improvement of 1,430,000. So removing from that, we have what's it called? 7.5. Head office shared of R&D is not allowed for CI hydrocarbon, but is allowed for CIT. Bad debt only for CIT. Administrative costs, we have treated that the other time. Miscellaneous expenses, we have treated it. You remember we talked about that. I have told you interest on loan or borrowing. Interest on borrowing is not allowed. Stamp duty is allowed for hydrocarbon tax, and it is not allowed for company income tax. Because I have told you, when we were doing company income tax, I said any form of tax liability is not allowed. The next one is bank charges. Bank charges is not allowed for hydrocarbon tax, but it is allowed for company income tax. So, with that, we get our total OPEX. Our total OPEX is 619,630. We need to go and test that 66, what's it called? That 65% of our revenue. Our expenditure must not be more than that. So let's go. That is what will take also CPR ratio limits. Now, what are our gross revenue? We have it. Maximum of it should not be more than 65% of the gross revenue. 65% of our gross revenue is what? Is 1 million. So, and I said, you are now also going to compare with your OPEX. Total operating expenses that we have is 619,630. We said add back capital allowance. Hold up, please. Okay, guys, sorry. So you take your total OPEX, which is this value. You will add capital allowance given in the question, and you will remove all these payments. These are the payments you will remove from it. You must know them. NDDC, host community, royalty, environmental remediation fund, and rent. Those are the things that you are removing from it. So whatever you have, you call it adjusted for CPR. Now, we will now compare this with this. The lower of the two is what we are taking. So we are taking this. You can see that we brought it there. Okay. So we go ahead. Now, this is what we are going to now compare. This guy, this value, is what you now compare with your sales, with your total revenue. So in the question, you see 606, we said it is now going to be 1,553,780 minus this 606. The 606 you got here. And that's what gave you this adjusted profit of 7,974, 947. But for the adjusted profit of SITA, it is going to be this minus the revenue, minus this revenue of SITA. This is not the total revenue of this guy. So we are looking at another question. Sorry, it is 1,560,000 minus total expenses for CIT is 649,930. So you will get this. You will get this. So remove loss from both of them. Loss. Okay, from both of them. Now, the allowance in this one, when we are doing our computation, so there is no need for removing capital allowance again under hydrocarbon. Do you understand me? So your chargeable profits here will be your adjusted profits, this one, less petroleum production allowance. Okay. So this 96,000 will not be there. I'm saying that again. Your accessible profits minus production allowance is what you should have here, not minus, because what you have here is accessible profits minus capital allowance and a production allowance. No, I am saying in ascertaining this value here, you have added capital allowance plus it. Do you understand me? So capital allowance will not be taken out from hydrocarbon tax again because we have already taken it out. So the only thing that you are going to recognize here is this value, okay, minus 80,000. Do you understand me?
No.
Let me say it again. Capital allowance should not be brought again to this place for hydrocarbon tax. It is going to be for company income tax. This 96,000 for hydrocarbon tax should not be there. Do you understand me? Because we have already taken care of it in this place when we are doing our cost profit ratio limits. So what we are recognizing is, where's my marker? What we are recognizing is only this. Only this and this. That is this one minus this one. Whatever it gives you is your chargeable profit. But for company income tax, sorry, I said this one. I'm sorry, I'm so sorry. I wanted to say this one minus this one, okay? But for company income tax, it is going to be this minus this, which is what we already have here. But for hydrocarbon tax, it should be this minus this, not this, not 96, because we have already taken care of the 96,000 in this place. Do you understand?
Yes.
Good. And you remember that it was this value that we brought here. So if you are recognizing capital allowance again, that is double dipping. Do you understand?
Yes.
Yes, sir.
That is that. So you now calculate your company income tax on that and your chargeable tax. That is it. Do you have any question?
So does hydrocarbon tax have the same tax rates as company income tax?
Thank you. Depending on the kind of operation they are doing. Now, if the company is a marginal field operator, it is 15%. I think I told you that before. No? Let's look at the tax rates and comment. Just hold on. I know I discussed the rates of tax applicable. So if the company is a marginal field, that is a field that was being operated by an oil and gas company, international oil and gas company, that has now been given or allocated to a Nigerian company. So it is going to be 15% that they will charge as their tax liability. If the company is not a marginal field, that is a company that is on production mining license. Now, the production mining license company, this company, they have a very huge reserves, unlike this marginal field. They have very little reserve. But for big company like the likes of Shell, ExxonMobil, they are going to fall under this category of company that will be paying 30%. So for example purpose, examiner will only give you question on what's it called? Company that is not marginal field. But if the parameter of give you a marginal field, note that marginal field rate is 15%, not 30%. But when it comes to company income tax, they will still pay 30%. But for the hydrocarbon, they will pay 15%. Do you understand me?
Yes, sir.
Good. So for hydrocarbon, for marginal field, it's 15%. But for companies for company income tax, they will pay 30%. So I could have also said that this place, they will pay 15%. Let me go and show you something. Let's show you something. I know so this is the tax rate. Can you see it?
Yes, sir.
So that's what I'm talking about, this and this. So if the company is in marginal field, PPL, company that is just doing appraisal of, they have not really been producing, but they have discovered crude oil, okay, and they have discovered gas. So in terms of rendering their return, they will be paying 15%. Before appraisal, it is 0. Appraisal, that means it can own and dispose. So that is that. You know why these companies are paying 30% for company income tax? Because we have a threshold for company income tax according to Finance Act. and an oil and gas company will be making more than 100 million in a year. And therefore, in terms of revenue, and therefore their tax rate will be 30%. So that is why for that one. Oh, let's do one more question. Do we see after? We don't have time. Do you see have class after this, my class?
Yes, I will have case study.
Okay. So go and try your hands on the other questions. If you have any question, you let me know. Okay?
All right, sir. Thank you,
So
sir.
just like I've promised, I'm going to be available all through for you guys to write your exam. So in case you have any question, feel free to contact me. Okay?
So is this our last class
This is our last class.
on tax?
Yes. For my own end. I don't know what for which I use. I will ask you.
All right, sir.
All right, good issue.
Thank you, sir.
All right.
All right.
Before we go, hello everybody. Before we go, can you please show your face so that I can know my students? I don't know any one of you, except for Amaka that I've seen our picture here. Well, yeah, show your face. Amaka. Okay. Blessing, here talk. Let's see so that the picture can come out.
Okay.
Yeah.
Morning, sir.
Morning, how are you?
Fine, thanks, sir.
Believe, yeah, show your face.
Morning, sir.
Let's see it. The handsome guy in the class. I can't see your face, to believe. Nobody can see your face.
Maybe this kind of system I'm using.
Fake system. Oh yeah, Umbong Victor.
Well done, sir.
Victor, correct guy.
Yes, sir. Thank you, sir.
Long time. Well done.
Yes. Sure, sir.
That's Victor. All right.
Yeah.
Umbong. No, see your face. Oh. Oh yeah, talk. Talk.
Thank you, sir. Thank you, sir.
Yeah.
Thank you, sir.
All right.
Mm.
Okay. Have a nice day, everybody. If you have any question, feel free to contact me. All right. Good day to you.
All right, sir. Good night. Yeah.
All right. Send it out.